Welcome back to Market on Close. Time to talk about today's action because it is rough waters once again for equity traders, especially those bullish. I want to bring in our guest, Alan Nuckman, is joining us, the Chief Market Strategist at Agora Financial.
Good afternoon.
Glad to have you here on a busy day. Scott Connor is joining us as well, of course, the host of Virtual Trade, and Nick Theodorakis, Financial Risk Management Director at TD Ameritrade. All right, so Alan, I was joking today that you tell me your title, I'm going to tell you why you think the market's selling off. Because there's so many things to choose from.
Chief Market Strategist, you're asking my title? Is that what you're asking?
I'm saying, well, then that one, maybe I'm going to go with valuation repricing. You know, it's like if you're a geopolitics guy, you think tariffs are the reason.
Right.
If you, or maybe you think Saudi's the reason. If you are a bubble guy, then you think, of course, well, this was only a matter of time. You could go on and on, basically, for all the reasons people will point to. Or if you like to blame the Fed, you blame the Fed.
Right. You can always find the crisis du jour to justify the market move. But I try and make it very simple. The market sold off. Obviously, we were up at all-time highs just not so long ago. Had some unwinding, some much-needed profit-taking unwinding. And then we've bounced about 50% of that. So I try and make it very, very simple. Look for these midpoints that act as support resistance. So we bounced from 2710 in the S&P up to 2825. 2825, we got to 2816. So we got almost to the halfway point, stalled, sold off again. So today, 2760, to get wonky with this, is a very important kind of pivot to keep an eye on because it's a halfway of the halfway. But what I didn't see today is I didn't see the financial flush out that I typically like to see to wash the markets out one more time before they go higher.
So how do you know that this isn't the washout, dog? 2.5% down on the NASDAQ?
It just didn't feel it. It didn't feel like the violence that we've seen in the past. You know, you like to see markets test and reject specific levels and bounce back. And yes, today was unwinding, but it just, to me, felt more orderly than like we've seen in the past. And I don't feel the fear. Look at VIX. The VIX closed right around the 20 level. 20 is the halfway point of this recent action. We rallied from 11 to 29. So, we're right to that midpoint right now, just sitting steady.
Yeah. All right. So what are we sort of learning here, Scott, in terms of what makes investors nervous? Can we pinpoint anything on this? I see this search, and I feel like it makes them feel better. It helps them sleep at night if they can say, oh, here's why the market sold off. But, for this sell-off, I don't know. I never really felt the need to ask for a reason. It's just since the beginning of the year, basically, when we knew the Fed had this, objective to keep hiking, that volatility is going to be here. February was a big wake-up and warning.
I think it was. I think we always have the wall of worry. That's there, and that list kind of changes. Different items get added and taken away from it, but some come into focus. And I think obviously going into earnings, there was a lot of fear kind of around that particular uncertainty, if you will. We had two great quarters. The question is, couldn't we continue? Many people were saying we could not. So there was some nervousness. We sold off the NASDAQ 10% going into earnings. Now we're sort of getting through earnings. We're seeing there's no disaster so far. Banks led the way, started off things very well. So I think the shift, as long as earnings keep coming in as expected, is to bigger sort of economic concerns. And I think one of those that has not gotten a lot of attention is China.
Well, I mean, hey, it's got a pretty good amount of tension, I'd say. The market is down a tremendous amount just overnight again.
Right.
Obviously,
well, I was going to say, we've been focused on the Fed and interest rates,
sure.
but I think that has always been there. I think we're getting through that. And of course, 10 years just sitting here at 3.17.
Yeah, you can't blame it on a spike in yields today.
It stopped dead in its tracks. It's not going any higher for the time being. So I think we're looking at other things right now, and I think China is one that's coming back into the forefront.
In fact, we saw a little bond buying that happened basically from about 11 a.m. New York time, 10 a.m. here. We started off higher yields in the 10-year, and then when things started getting a little rough, kind of right before the stock market started tanking, Nick, you saw some buyers come into treasuries.
Yep. Yeah, the rate, I would have expected rates to be higher than they are, on another move like this today. I think it goes to the earlier point of isn't the flush out. This isn't really the disaster that we're seeing. We're not seeing that flight to quality or flight to safer investment. Gold's up a little bit.
Yeah, I was just about to say gold's pretty quiet.
Like it's been fairly quiet. You're not seeing people jumping into other things. This is sort of okay, maybe I'll wait till tomorrow and there'll be a buying opportunity. It's move to cash a little bit. Our short-term memory, we always talk year-to-date type stuff. Our short-term memory is, it looks pretty bad. And I think in China it does, right? We're down 25% in China this year. It's kind of ugly. Here, we're up almost 400 S&P points from this time last year. So if you look at a 1-year picture, we're still up pretty good, right? Like this is a bit of a blip right now.
And how long ago was we were at all-time highs?
Yeah.
Let's not forget. It's
Like
only
September
been a couple weeks. It's only been a couple weeks.
Exactly.
So
Yeah.
what have you done for me lately?
It depends on it. It's been a while for the Russell. Things are feeling a little rocky out there in the Russell. Should we be concerned, Alan, that every time this happens, it's led by the very market cap, heavy stuff, tech, discretionary names, the leaders on the way higher?
No, unless you were concerned about the fact that the large cap companies were not going up when the Russell was going up 6 months ago.
Right.
So it's just a shift in mentality, a shift of rotation. It's a rotation, and it's just looking for that opportunity. And the money flow came out of those Russell stocks that had the big run, went into the Dow stocks. The Dow stocks had a big 10% run in 3 months, and so that's just money movement. So
Yeah.
I think a good point was made that you did not see a rally in bonds, you did not see a rally in gold. We saw a minor bounce. I mean, in the VIX, if you look at it in point terms, and we're right at that midpoint there. So I think it's important to talk about what happened last Friday. Friday was finally fundamentals, and you talked about the banks.
Right.
The 5 banks that came out with earnings numbers, between them, they had $30 billion in quarterly profits.
Morgan
all
Stanley
beat-
beat every
they all
single
beat.
metric.
I wasn't even including Morgan Stanley. I was
Yeah.
J.P. Morgan, Citigroup, Bank of America, Wells Fargo, and Goldman Sachs. $30 billion for those guys for the quarter. So let's not feel bad for the banks. I think they're doing okay.
Right.
That's a profit. That's just pure profit for the quarter. And that's reminded the market of really what truly drives stocks. It's not all these fear factors. We're not in the why business. I say that all the time. We're more in the how business. How is the market going to move, and how is money going to flow into certain asset classes? We're not in the why business. We can look back later on and say, okay, that's probably why that happened, but at the time, that's not the most important thing.
Tough. Yeah, and that kind of goes right in line with, I think, the search for a catalyst that people need.
But people like to feel like they know what happened.
You're right. I do spin narratives sometimes. I'm guilty of it
Well,
too.
look at our sectors.
Yeah.
There's like a little hot potato going on right
Right.
now. You can see techs, everyone piles in one day, we're up 4%. Today we're down 3%. This is the same tech group that the other day everyone was risk on. So I think there's a lot of uncertainty as to which sectors are carrying through. But to Alan's point, banks after that earnings came out Friday, they had a great 2 days to
Right.
follow that up. I mean,
Didn't last though. Down again today.
No, well, the whole market. I
The
think
timing is
down, but you're
interesting.
absolutely right.
When there was no earnings news, right? We were bad news, and nobody cared.
Right.
Nobody cared. We were sideways to flat. We kind of made that push to all-time highs, but kind of sideways to flat, like in the first, since last earnings cycle. Now earnings are coming out good, and we're seeing this volatility. I think the timing is interesting.
Hey,
All news is
investors
bad news
didn't
right
think
now.
earnings were good for Uri. They didn't think they were good for Snap-on. They didn't think they were good for Textron, the 3 biggest losers in the S&P. We're going to talk about those in a second. We got a short break. Alan Nuckman's with us. We'll be right back on Market on Close.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Welcome back to the TD Ameritrade Network. The closing bell at the New York Stock Exchange and the NASDAQ market site, both in Manhattan. All right, and it's a little bit rough once again for equity investors. Futures, going to read those numbers off here as the indexes settle. NASDAQ down 2.5% in the futures. Russell 2000 E-minis down 2%. The index a little bit better. We've got a ton of after and pre-market volatility this past week and a half, so it all depends on what your measurement is. The Dow down 1.3%. Either way, though, it's pretty much red across the board. Can't hide from it, except for the VIX, which popped up 220 rather, I should say. About 2.6 points on the VIX. Or if you live dangerously, 15% on the VIX. All right, crude is down below 69 bucks. We had a build that was larger than expected yesterday, and tensions between pretty much the rest of the world and Saudi, everyone but Russia pulling out from that Davos in the desert. So lots on the way of geopolitics, of course, earnings. We just mentioned before the break, URI, Snap-on, Textron, the worst performers. Bring up the chart, guys. Nick, I want to come back to you on this because you left us on the earnings front. And we got a heads up for this too, right? PPG last week, a different company, paints and coatings, but they, clearly this isn't academic in theory. Inflation, higher prices, and higher wages and freight costs.
Yep.
All these things are weighing on companies.
They are, and you start to add in things like mortgage rates are up, right? Housing sales have to be hurt by this. There's a lot of stuff that come with a higher interest rate environment that a lot of people, first-time home buyers, first-time investors haven't seen, right? This has been really since 2008 that we've seen sort of things kind of ratchet up, and pre-2008 that we've seen things sort of ratchet up in this way. And I think you're right. You add in then tariffs to that, and we see some of these companies are going to get hit. We've talked about this a lot of times on the show. How many companies really are going to be impacted versus how many use it as a crutch to make an excuse for a weaker than forecasted earnings cycle?
We see the dollar getting tossed out a little bit right now, as we'd expect. One of the companies we saw up there was GE. What I'm curious to hear from you guys is how you find safety or hedge in this market. Even though on the worst days, some of the best performers are the ones getting slammed, it's also the companies that are down a lot. It's hard to find a thematic place to go, but some of these companies have done it right. A company like GE, which is purportedly in a turnaround, Alan, but also more reliably perhaps the volatility has been Virtu, HFT market maker, where after February, the earnings that they reported after that were monstrous because they love the vol. They can actually make some good money.
Well, that's the one thing with this vol picking up right now. As a trader, that's opportunity because there are so many different things you can do now, and I'm an options guy. So I'm not a believer that the bull market's broken. So if you look at something like GE, you could sell some puts, some cash secured puts on the stock, sell some, 12 puts or
If you
whatever.
think it's bottoming out?
If you think it's bottoming out, get paid if it doesn't, and so it's a win-win situation. You're buying into it at a lower price, at a discount, or you're getting paid not to. So it's a win-win situation. As that volatility kicks up, you can use that strategy on stocks that you like if you're prepared to get in at a lower level. It's just the complement to putting in a limit order and letting the market come to you. You're selling a put. You have the money in your account to buy it. It's not a naked cash put. It's a covered put situation. You're using that as a way to buy a stock that you want. Look forward to rebound.
You just got to make sure when you're picking bottoms, you don't accidentally grab a Newell Brands instead, which is down 6.5%.
Well, and the other thing I was just going to add to that, this is ironic you brought this up because sometimes people, instead of selling the put, they'll sell the put spread. And today in GE, a 10-12 put spread traded 195,000 times in one trade.
Okay.
All right, now that's the size of trade we don't see very often, right? So somebody is obviously taking a very big position in.
So they're selling that put spread?
Well, we never know exactly if they were sellers.
We'll know tomorrow.
Yeah, we'll know tomorrow.
When we can see the open interest.
There are certain cues that you can take from that,
Right.
like did the stock go up or down after that? Stock actually rallied a little bit, so you can
Which one
take
was
cues
on the
from
bid,
that.
which one was on the ask. So.
Exactly, so we can see that, but that's still, again, you were just talking about potential hedges or looking at a stock that you think is at or near a potential low. There's all sorts of strategies.
It's
We can see that.
an interesting way to think about until there is this huge purge, the financial unwinding, as you put it, Alan, from the market where everything gets slammed. There are some things that are offering some degree of, I don't want to call it safety or gains, but even the utilities and the real estate today we're in the red, but not that deep in the red. We start off the show talking about some of the dividend growers, ETFs to track things that have a little bit less volatility, say like a USMV. But overall, most of these stories were pretty specific to the companies. Philip Morris on the back of their earnings. Macy's is one of the few retailers that stayed afloat. Anything that clear that will keep you protected in this type of market?
No, I think just to keep kind of talking the trading side of things is really not, right? This is a pretty broad-based sell. If you look at those names, I don't think those are safety names in the
AutoZone yesterday got slammed.
Right, exactly. So, I do think that if you're in these stocks and you're worried about a move lower, puts are a bit more expensive now, but you still have the ability to hedge yourself here if you want to stay in your positions, right? And then to the guy's points, I think it's puts or put spreads being short here allows you to buy these things at a pretty significant discount from where we were a month ago.
Yeah. Alan, what about the idea of gold if you think it's bottomed out?
Well, gold finally broke out. Okay, now we didn't get any follow through today. You would have thought today could have been a secondary move to the upside. Gold had been trading between 1185 and 1215.
I was surprised gold
for
was silent
6
today.
weeks. Yeah. And so a lot of the correlations that, as an old trader like myself, that you look for have disconnected. So you don't get as many clues to what's happening by the counter moves in other markets. So I still think gold has a lot more upside potential. Now there's gold, GLD, and then there's GDX. I probably myself, as an options trader, if I'm looking at gold, I'd be looking at some gold futures options because they can give you a bigger payoff. It's a larger size contract than buying a whole
Or if you want to
bunch
live
of
risky,
GLD.
you go get a miner.
Right. The GDX, if you look at the GDX, it's going to give you a bigger payoff when
Right.
gold breaks out. So
Right.
it's just be more aggressive. I'm not into the
Bigger loss if it goes down.
I'm not into the multiple index funds that have 2 or 3 times leverage. I'm not into that. But I think GDX is a level of leverage that I'm prepared to take because we hit lows at 1167 in gold not that long ago. So we kind of know what the near term bottom is.
Hey, guys in the control room, if you could put GDX and GLD on 2 different axes year to date, 'cause I just want to show that high beta nature of the miners so that people can get that sort of in their head.
Usually about twice as much. So I think
Right.
gold is down 6% so far this year. And so let's see where GDX is. But I mean,
Yeah.
it's a stronger play
beta.
if you're right.
If you're right.
So Scott, obviously part of the thing that we talk about here is that you look for bonds, and maybe today that worked, but if we are dealing with the big macro issues that we have, it depends on what you want a bond for, but the days of the price going up, probably over for now.
Yeah, I think it's been very interesting throughout this is to see the traditional safe havens have not proven out to be what they have been in the past. We typically look for bonds, Japanese yen, we
Right.
look at gold. These things have not been participating on the way. Now it has been VIX, right? We've seen VIX reacting and the VIX future moving in that direction.
But it gives up its
you're right.
gains very quickly.
Very quickly. And that's the thing, since it's a mean reverting instrument, it's not one that can continue through.
Right.
So you have to
Grab
be
it when you have it.
You have to be agile
Yeah.
if you're trading that product. Absolutely.
You can't, that's not a buy and hold
Yeah,
type
you can't sit on
strategy.
it.
And
Right.
that's- Oil to me is the other interesting one you guys didn't mention. I mean, I think with the turmoil in the Middle East, and it's some headline stuff maybe more than production, but to see oil down today, I think is
Yeah,
a pretty
it's been down the
interesting-
past couple of days when
Yeah.
you think this kind of geopolitical concern, let's put it mildly,
Right.
could give that market another leg higher, which it's had no impact. So sometimes it's as important to see what doesn't happen as what does happen, when you get these kind of moves.
Let's talk earnings. Let's talk some of the names that are coming out here in a sec. Guys, if you want to bring up American Express in the aftermarket, a solid EPS beat for American Express, a solid revenue beat as well. It's pretty quiet in terms of just the trading right now, 102.75, but we're going to see how that opens up when we get some more activity here in the aftermarket session. Amex is raising its fiscal year adjusted EPS guidance to 730 to 740, which is a 10-cent climb on the higher end, but a pretty big bump from the lower end of the range. They thought it was going to be 690, revising that to about $7.30. So it's a pretty solid earnings report, but what I'm learning, Nick, is essentially confirming what we suspected coming into this earnings season, where a company like American Express, you may not have to deal with tariff stuff, you may not have to deal with input costs to some degree, but there is an overall hesitation to really just send these stocks upwards that have been very far upwards. Even look at Netflix, where we had this massive aftermarket move and it just kind of got crushed
Ground
throughout the
back
next
down,
session
yeah.
the next day.
Yeah, I wouldn't be horribly surprised if we saw that reversion back to basically unchanged here in American Express. I do think that they're a pretty straightforward company when it comes to their business model. They, it's an interest rate play, right? And basically they're the highest fee charger of the companies. Right? They know they can charge businesses. They have a lot
So
of
charging
business accounts.
companies.
They charge companies, and they charge a pretty good premium for their branded cards compared to other competitors. In a rising rate environment, their rate to keep it higher goes up in tune with that. And I think, that they're a strong interest rate play here. Again, I wouldn't be surprised if they are basically
Do
unchanged
they have
tomorrow.
less
because it's factored
uncollected
in.
debts because people are supposed to pay off their credit card every month?
Well,
I
that's
never actually looked into that.
No, well, that's interesting because from the banks that we saw, JP Morgan Citi with the big credit card exposures, basically have been putting less off in provisions, less off in terms of bracing for a credit downturn. American Express, we'll see how the numbers come in. But last time, most of their expenses are actually about marketing and about giving people, discounts to encourage that membership.
That stock doubled in the past 2.5 years. Let's be aware of that. Let's go in the Wayback Machine. Do you remember when they got disconnected from Sam's Club? Not Sam's Club,
Costco.
Costco, yeah.
And
It's a
everybody,
big deal.
they acted like American Express was going to go out of business. So that it was another example of that once the distress wore off, people realized that nothing changes.
Yeah.
I was going to say, just keep in mind, it's dropped about 8% since late September.
Since the high.
Yeah, exactly.
But it had doubled. It had doubled.
Oh, no,
in
it's
2
actually
years.
been on a great run. But I think it's interesting to look at what the options were telling us before earnings. Now, they've beaten on 5 out of the last 8 quarters.
Yep.
But going in, they were looking for about the average move. The at-the-money straddle was about 3.5%. So this is equated to about $3.70. So it'll be interesting. That's the expected move.
So pretty
Reading
quiet
from the options.
expectation for the options from the options
About
market.
3.5 to 3.75%.
Yeah. What's interesting about Amex, of course, is it's one of these companies where you could look across the market and see companies spending money, right? That type of business activity, the NFIB surveys, the CapEx numbers from the first and second quarter that were very big numbers year over year comps. You think Amex is a company that sits right there within that, but as they compete with others, it's another one of these themes where what we talk about around earnings season. There is intra-sector types of dispersion that show up, where Visa is a company that is now basically trading like a tech stock, where Amex has had a great run, as you point out. Visa is trying to keep up with Square, trying to keep up with the very tech-heavy stuff. We're going to get PayPal in a sec, and then all of a sudden it starts trading at multiples 50, 60 times.
Right.
Yeah, and I think you end up with the cities of the world issue a lot of these branded cards now too. There's a lot of other players in that space, and they have to be basically connected now with the MasterCards and the Visas. But you're right, there are other players. People are looking at Square Cash. There's PayPal's coming out here, right? There's other ways to kind of think about this that cut out some of these brands. I think Amex, this earnings to me with Amex, looking through some of the stuff is. They still have that niche, and I think one of those big pieces is the corporate niche.
And let's not pretend this segment doesn't have a huge profit margin. Let's
That's
look where
exactly right.
interest rates are here and the interest rates that they charge here. There's money to be made in the
there's
middle.
money to be made.
There's
Yeah,
money to be
sure.
made in the middle.
3Q provision for losses, $817 million, to your point, Alan. And you look at just overall as you pointed out, a pretty solid number across the board for what they did. Scott, I actually want to come back to the market maker move, because when you see that type of expectation being kind of small, to be honest, for a company like Amex that's done so well, then do you bet on it going to the other side, that it will surprise?
Well, you could, but I think what most traders do is they'll take that expected move. They'll go back 8 quarters and say, now, is this sort of in line with where it's been? And this 3.5% move is averaged over the last 8 quarters. So again, what we're seeing here is somewhere around the average expected move over the last 2 years.
But if you bought a straddle, you're not going to be
no.
at that much risk anyway. So you could play that in a larger expected
Sure. If
move.
you think
than
it's
what
going to move,
happened.
if you think it's going to move more than 3%, 3.5%, buying that straddle might be
Right, and there's not a whole lot. As a trader, the most important thing, the things professionals focus on is your downside risk. What's our worst case scenario? What's your worst case scenario if you're buying a straddle?
Stock doesn't move.
Yeah, stock doesn't move. You get out of it tomorrow and you lose some vol.
Alan, we talk macro a lot, but are you drawn to company-specific trading in an earnings season where you see the type of volatility that we're looking at right now?
The answer to that is no. I'm interested in longer-term trends in companies, but I don't care about the earnings. I think earnings can often just be a catalyst to get the market, to get that market movement. And sometimes you're going to get a relief rally after the earnings, even if the numbers aren't.
You're a price guy.
I'm strictly a price guy, right?
Fundamentals are
You're
stories.
giving me a headache just looking at all those serious numbers.
Look at Netflix.
It's in the charts. It's in the charts.
Well, here's what I can say. From that macro side, though, when we consider some of these things, what I'm curious about that we're going to look at for Amex, and George is going to give us a rundown here in a sec, comes actually back to, ironically enough, the fundamental point that Alan brings up, because there's all this concern we hear about health of the consumer. From what we've seen from these companies that have that exposure on the credit side, we talked about it for the banks. Yep. We're going to talk about it when these numbers come in. For Capital One and Discover will give us more of a pinpointed view on that, given their higher risk exposure to that part of the market. But it feels like it's all clear here for that type of risk.
I think we sound a little bit like a broken record. Sorry for everybody that's hearing it, but all these numbers are strong until literally 2 weeks ago, right? These earnings aren't going to reflect what we're seeing in the markets today. First of all, right? This is a disconnect to these earnings, right? Because we're not in a situation where any of the volatility of the terror are going to be reflected in these companies. And like Alan said, there's a lot of profit margin here, right? The tax effect is still there, right? People were, spending a bit more this past quarter. We know that, like, we got 1, maybe 2 now softish retail sales numbers, but in general, they've been really strong numbers for months and months. So not surprised to see their revenues up based on that spend.
Yeah. Well, we may react directly to what's happening. You got to understand there's a lag time for the rest of the economy and the rest of the consumers. They're not going to get as necessarily concerned about things right off the bat.
Right.
It may take a couple weeks, couple months.
I was going to say, look at the Fed's minutes the other day.
Right.
They came out and said household spending is strong. They expect that to continue through the second half and the latter half of 2018.
Alan, tomorrow we've got pretty quiet day for data. This is what I want to leave this conversation on. Existing home sales, but unless there's some massive surprise there, we know all these numbers have been negative. Even a good one is probably not going to change a lot of minds on that. It's quiet, but it has been, once again, an important week. What are you going to look for tomorrow? How do you come into the session tomorrow morning?
I was looking for that financial unwinding that I didn't quite see as much as I wanted to today, so we'll see if there's follow-through on it tomorrow and how the market reacts. I talked about that 2760 to me seems to be a very important number in the S&P. It's a halfway mark of this recent little rally. So as long as it can stay above that, I think near term we're good. I think intraday we're probably going to make a couple more tests. That's typically how these things end.
Exactly.
But it hasn't happened just yet. I mean, today didn't feel like much. It was down 2%. Yes.
What's the washout you want to see? I mean, we have VIX inversion, where we got the backwardation of the volatility curve. We've got we had a 4.5% day drop. My calculation, my tally of companies in bear markets keeps getting bigger.
True, but let's look. Coming into today, the NASDAQ, the NDX, was 5% off the lows from last week and 5% off its all-time highs. Okay? So, I mean, it's not we're not in a catastrophic territory by any means. Right. This is healthy unwinding. Unless you think it's different this time, I certainly don't. We've rebounded from every single crisis we've had, and we don't have time to list them all.
You're not losing sleep over breaking the 200-day moving average?
No, that was a test and reject, and it came right back above it. So let's see where we are by week's end. If you're unsteady, I like to look at things on a weekly basis, and you can kind of filter out some of that volatility.
I think tomorrow's close is going to tell a lot, because a lot of people are looking for a retest of Thursday's lows last week. If we hit that, like you said, and bounce off again and have a pretty positive close on Friday, tomorrow, of course, that could bode well.
All right, there we go. You guys are getting deep in the levels. I got to talk some fundamentals. We got charts after this. Al Nachman is with us once more, Chief Market Strategist. Great contribution to the panel. Thank you, Mr. Nachman, as well as Scott Connor and Nick Theodorakis. All right, guys, we got to talk a little bit about some of the railroads, because we saw both companies that were leading the upside, CSX as well as Norfolk Southern, get crushed last week in the sell-off. We just had earnings last week from CSX. We're going to chart a few of the other peers here as we look at that industrial sell-off in the market today. Then we're hitting earnings and